Welcome to Investing Lighthouse, where we explore the world of investing. In today's video, we're going to talk about a topic that's crucial for anyone who wants to understand the economy: inflation and interest rates. Inflation can be defined as a sustained increase in the general price level of goods and services over a period of time, while interest rates are the cost of borrowing money or the return on lending money. In this video, we'll explore how raising interest rates can help control inflation and why investors must keep an eye on inflation and interest rates. To comprehend the connection between interest rates and inflation, let us examine some historical cases. Inflation has caused many economic crises throughout history. Germany's hyperinflation during the 1920s is a typical illustration. Following the conclusion of World War I, Germany found itself struggling with a significant amount of debt and reparations payments. In response, the government decided to print more currency, causing a rapid surge in prices. This rapid inflation rate peaked at close to 30,000% per month, resulting in widespread poverty and social unrest across the nation. For context, prices doubled every 3.7 days during that month. To address the rampant hyperinflation, the German central bank opted for a drastic increase in interest rates. As a result, the inflation was eventually curbed by 1924. However, the high cost of stabilizing the economy was significant, as it impacted social and economic stability in the country. The 1970s in the United States saw a rare economic situation known as stagflation, where both inflation and unemployment rates increased simultaneously. This was caused by a combination of factors, including a rise in oil prices and expansionary fiscal policies. The high inflation levels were a significant concern for policymakers, and the Federal Reserve responded by raising interest rates. Despite these efforts, the U.S. economy struggled with stagflation for several years, causing significant challenges for policymakers and investors alike. While this policy was effective in controlling inflation, it also led to a rise in unemployment and a recession in the early 1980s. One of the most memorable examples of using interest rates to control inflation comes from the 1980s in the United States. In the late 1970s and early 1980s, inflation in the US was spiraling out of control, reaching over 14% by 1980. In response, the Federal Reserve under Chairman Paul Volcker raised interest rates to unprecedented levels, with the federal funds rate peaking at over 20% in 1981. While these high interest rates were painful in the short term, they ultimately succeeded in bringing inflation under control. By the mid-1980s, inflation had fallen to around 3%, and interest rates were able to come down as well, leading to a period of economic expansion and prosperity. More recently, we can look at the experience of Brazil in the early 2010s. Following the global financial crisis of 2008, Brazil's economy was booming, but inflation was also beginning to pick up steam. In response, Brazil's central bank raised interest rates from 8.75% in 2010 to a peak of 14.25% in 2015. While these high interest rates were challenging for Brazilian businesses and consumers, they ultimately succeeded in bringing inflation back down to more manageable levels. By 2017, inflation in Brazil had fallen to below 3%, and interest rates were able to come down as well, helping to support continued economic growth. Now that we've looked at some historical examples, let's dive deeper into how raising interest rates can control inflation. When the economy experiences rapid growth, demand for goods and services increases, which can cause prices to rise. This phenomenon is called demand pull inflation. By increasing interest rates, the central bank can limit the amount of money available for borrowing, which can decrease spending and slow down economic growth. When borrowing money becomes more expensive, consumers and businesses may be less inclined to take out loans and make purchases, resulting in a decrease in demand and a subsequent decrease in prices. Higher interest rates also make saving money more appealing than spending it. This results in a decrease in spending, which helps to alleviate inflation. Furthermore, an increase in interest rates can boost the value of a currency, making imports more affordable and reducing inflationary pressure even further. So, we can see that raising interest rates has historically been an effective tool for controlling inflation. However, it's important to note that the relationship between interest rates and inflation is not always straightforward, and several other factors can also influence inflation. For example, if inflation is driven primarily by supply-side factors, such as rising commodity prices or supply chain disruptions, then raising interest rates may not be the most effective tool for bringing it under control. In these cases, policymakers may need to focus on addressing the root causes of the inflation rather than relying solely on interest rate adjustments. While raising interest rates can be an effective way to control inflation, it's not without its risks. Increasing interest rates can lead to a decrease in consumer and business spending, which can slow economic growth and lead to unemployment. Raising interest rates may cause higher borrowing expenses for both governments and corporations, which could put pressure on their budgets and lead to defaults. Moreover, if interest rates are raised too fast or too much, it can result in an abrupt shock to the economy, causing a recession or even a financial crisis. To ensure that the decision to raise interest rates to control inflation is balanced, policymakers and central banks must weigh the benefits and risks. In doing so, they must also consider the wider economic and social implications of their decision. This requires an understanding of factors such as employment rates, income inequality, and financial stability. For investors, it's always important to keep an eye on inflation and interest rates because they can significantly impact asset prices. When inflation is rising, stocks, bonds, and other assets tend to lose value as investors anticipate higher interest rates and slower economic growth. However, some investments tend to perform well in a rising interest rate environment, such as stocks in certain sectors like financials and utilities, as well as certain types of bonds such as short-term bonds and floating-rate bonds. In conclusion, raising interest rates has historically been an effective tool for controlling inflation, as we've seen through the examples such as the US in the 1980s and Brazil in the early 2010s. However, this tool is not always appropriate or effective in every situation, and policymakers must carefully balance the benefits and risks of interest rate adjustments in order to promote long-term economic stability and prosperity. We're always open to hearing your thoughts, so don't be shy. Let us know what you think in the comment section below. If you found this video informative and useful, please show us some love by smashing that thumbs up button and subscribing to our channel. Thanks again for watching, and we look forward to seeing you in the next video.